Right now, as you're watching this, there's a company voting your shares, not asking you, not consulting you, just voting. You think you own Apple stock, Microsoft, Amazon? You don't. You own a receipt. They own the actual power. This company controls $10 trillion, votes in 16,000 shareholder meetings yearly, is the largest shareholder in 495 of the S&P 500, and most people have never heard of them. This is BlackRock, and by the end of this video, you'll understand why one software system managing $21 trillion might be the biggest systemic risk nobody's talking about. Let's get something clear. BlackRock isn't a bank. Banks take your deposits and loan them out. BlackRock doesn't touch deposits. BlackRock is an asset manager. Pension funds, insurance companies, and you through your ETF. Everyone hands them money to invest. The fee? Usually 0.03% to 2%. The scale? $10 trillion. That's not an abstract number. That's more than Japan, Germany, and the UK's GDP combined. 40% of total US economic output, more than all US currency in existence. And BlackRock isn't alone. Add Vanguard, $8 trillion, and State Street, $4 trillion, three firms, $22 trillion, 90% of US GDP. But here's the difference. Vanguard is owned by its fund holders. BlackRock is a publicly traded corporation with profit incentives. This matters because BlackRock makes decisions to maximize BlackRock's profit, not necessarily yours. 1988, Larry Fink loses $100 million on a bad mortgage bet at First Boston. Gets fired, but he learns something. Risk management is everything. So Fink builds a risk management system called Aladdin, Asset, Liability, Debt, and Derivative Investment Network. Initially, BlackRock manages money for institutions. Then 2009 changes everything. BlackRock buys Barclays Global Investors for $13.5 billion. This brings iShares, the world's largest ETF platform. Suddenly, BlackRock isn't just managing institutional money, it's managing your money through index funds. And here's the kicker, you don't vote those shares. BlackRock does. Today, the iShares S&P 500 ETF alone holds $400 billion. That's millions of votes in every S&P 500 company. Multiply this across 1,130 investment products, you see the power. BlackRock doesn't own 91% of one industry like Standard Oil did. It owns 6 to 8% of every industry. Let me show you. Technology. Apple, 6.8%, $200 billion. Microsoft, 7.1%, $210 billion. Amazon, 6.2%, $110 billion. Tesla, 5.6%, $45 billion. Google, 6.4%, $120 billion. Meta, 7.5%, $85 billion. Nvidia, 6.9%, $90 billion. Banking, JP Morgan, 6.8%, Bank of America, 7.3%, Wells Fargo, 6.9%, Pharma, Pfizer, 8.1%, Johnson & Johnson, 7.4%, Merck, 7.9%, Airlines, Delta, United, American, all 6 to 7%. See the pattern? Now here's why this destroys competition. If BlackRock owns 7% of Delta and 7% of United, does it care which airline wins? No, it wins either way. So does BlackRock pressure airlines to compete on price, or does it prefer they all keep prices high, maximizing profits across the entire sector? The incentive is obvious. The data proves it. A 2017 study found airline ticket prices are 3 to 7% higher due to common ownership by BlackRock, Vanguard, and State Street. Airlines don't compete as aggressively because their largest shareholders own all the competitors. Same pattern in banking. Lower interest on deposits, higher interest on loans. Pharmaceuticals, higher drug prices. Tech, less innovation. This is monopoly by proxy, and it's completely legal. In 2020, BlackRock voted in over 16,000 shareholder meetings. Your shares, their votes. Here's how this works in practice. Every public company has annual shareholder meetings, board elections, executive compensation, mergers, strategy. If BlackRock owns 7% of a company, that's often the largest single voting block. Why? Because retail investors, people like you, don't vote. Most don't even know when meetings happen. Case study, Exxon 2021. Activist hedge fund Engine Number 1 owns 0.02% of Exxon. Nominates 3 directors to push renewable energy. Exxon management fights back, spends millions. The vote comes down to institutional shareholders. BlackRock votes with the activists. So does Vanguard and State Street. The activists win. A hedge fund owning 0.02% defeats Exxon's management because BlackRock's 7% was decisive. Every year, Larry Fink writes to CEOs of companies where BlackRock is a major shareholder. These aren't suggestions, they're directives backed by voting power. 2020, climate change. Align with Paris Agreement or we vote against you. 2021, racial equity and stakeholder capitalism. 2022 and 2023, net zero commitments and diversity targets. You can agree or disagree with ESG. That's not the point. The point is, one man's preferences amplified by $10 trillion in voting power shape policy at 500 companies without election or democratic accountability. Larry Fink has more voting power over corporate America than any individual in history, more than Rockefeller, more than Morgan, because he votes on behalf of millions who don't even know he's voting for them. This is BlackRock's secret weapon. Aladdin manages $21 trillion in assets, not just BlackRock's $10 trillion. Over 200 institutions license Aladdin. Pension funds like CalPERS, insurance companies like AIG, sovereign wealth funds, other asset managers. BlackRock software sees and analyzes 10% of the world's total financial assets. Why this matters? Aladdin doesn't just track risk, it recommends actions. If Aladdin tells 50 pension funds to sell a particular bond, they sell simultaneously. That bond's price crashes. This is algorithmic market control. The black box problem. BlackRock doesn't disclose Aladdin's algorithms, proprietary, but those algorithms direct $21 trillion in capital. If Aladdin has a bug, if its risk models are wrong, if it recommends the same action to hundreds of clients simultaneously, it could trigger a market crash. Remember 2008? Flawed risk models underestimating housing risk? Banks collapsed. Now imagine that scenario, but it's one model controlling $21 trillion. The information advantage. Aladdin gives BlackRock visibility into the entire financial system. BlackRock sees what other institutions are buying and selling before they do it. This is insider information on a systemic scale. BlackRock claims Chinese walls separate Aladdin data from investment decisions, but the wall is internal, no external verification. We're supposed to trust they don't use this God's eye view to front-run markets. March 2020, COVID crashes markets. The Federal Reserve needs to intervene, but the Fed isn't allowed to buy corporate bonds or ETFs directly. So the Fed hires BlackRock to do it for them. BlackRock was contracted to buy corporate bonds and ETFs on behalf of the Fed. BlackRock charges fees for the service and buys assets, including BlackRock's own ETFs. Let me be clear about the conflict. BlackRock was hired by the Fed to buy corporate bond ETFs. BlackRock manages the largest corporate bond ETF platform, so BlackRock bought its own ETFs with Fed money, driving up the value of those ETFs, benefiting BlackRock and its clients. BlackRock was player and referee. The reversing door. Brian Deese was BlackRock's global head of sustainable investing. In 2020, he left BlackRock to become director of the National Economic Advisor. Under President Biden, this is the president's top economic advisor. Michael Pyle was BlackRock's global chief investment strategist. In 2021, he became chief economic advisor to Vice President Kamala Harris. Adewale Adeyemo was BlackRock's chief of staff. He's now deputy treasury secretary, the number 2 official at Treasury. These aren't low-level staffers. These are top economic policymakers who came directly from BlackRock. The reverse flow exists too. Stanley Fischer, former vice chair of the Federal Reserve, joined BlackRock as senior advisor. Philip Hildebrand, former head of the Swiss National Bank, is BlackRock's vice chairman. This creates a closed loop. BlackRock alumni make policy. Policy benefits BlackRock. BlackRock hires more government officials. Loop continues. Not crude corruption. Sophisticated alignment of interests. BlackRock has more data about companies and markets than any institution except maybe the NSA. 3 sources. First, Aladdin sees $21 trillion in investment flows and risk exposures. Second, direct assets. $10 trillion invested everywhere gives access to corporate management. Third, political connections give early insight into policy changes. The advantage. If Aladdin data shows 30 pension funds planning to sell emerging market bonds next quarter, BlackRock knows prices will fall. BlackRock positions accordingly. Not insider trading, legally, but systemic information advantage. And information advantage is profit. Here's where it gets dystopian. BlackRock is publicly traded, so who owns BlackRock? Largest shareholder, Vanguard, 8%. Second, BlackRock itself, 5%. Third, State Street. But who owns Vanguard? Technically, Vanguard's fund holders, but Vanguard's largest holdings are the same companies BlackRock invests in, and BlackRock is one of the largest shareholders in those companies. The loop. Vanguard owns 8% of BlackRock. BlackRock owns 7% of Apple. Vanguard owns 8% of Apple. State Street owns both BlackRock and Vanguard. BlackRock and Vanguard own State Street. Same small group of asset managers own each other and everything else. BlackRock, Vanguard, State Street collectively own approximately 20% of every S&P 500 company and own each other.
This is 21st century monopoly. 20th century, one company dominates one market. Standard Oil equals 91% of refining. 21st century, 3 companies own 20% of everything and own each other. Effect is the same. Competition suppressed. Prices rise. Structure is legal because no single firm has majority control of anything. Just coordinated minority control of everything. Who wins? Larry Fink. Net worth over $1 billion. Annual compensation $25 to $30 million. BlackRock stock up 500% since 2010. Perfect business model. Assets flow in automatically. Fees accumulate. Don't even need to pick good stocks. Just own everything. BlackRock shareholders, mostly other monopolists. The oligopoly profits from itself. Corporations, CEOs love BlackRock. Why? BlackRock is passive, doesn't demand operational improvements. As long as the stock price rises, BlackRock is happy. BlackRock votes for management 95% of the time except on ESG. Management gets freedom to maximize their own compensation. Who loses? You, as a consumer. Common ownership raises prices